Thank you for tuning in and welcome to Mortgage Market Monday. Some things that happened this week. Jen and I are going to go over some things that happened this week in the markets. The number one thing that happened was the Fitch bond rating was downgraded for U.S. long-term bonds. Went from a rating of AAA to a rating of AA+. What this means is lower the rating, the more the yield has to go up. The more the yield has to go up, the higher the interest rate needs to be.
Oil prices increased by 63 cents a barrel, indication that some inflation might be seeping into the energy sector.
Number three, ADP payrolls were reported. 324,000 jobs were added versus 189,000 jobs expected. That's down from 455,000 that were added in June, which was actually a revised report. After initial reporting was 497,000 that were initially reported. This could signal an indication that the job market is starting to cool.
Federal Reserve Senior Loan Officer Opinion Survey sees tightened credit standards for business and consumer clients and are anticipated to tighten further through the rest of the year. Usually this signals a possible recession on the horizon, but with job growth being what it's been, it appears lenders are tightening the belt a bit before it becomes a crisis. Proactive over reactive.
Number five, the weekly job losses claims came in line with what the expectations were. So that's pretty copacetic, didn't really have any real effect on the market as expected. Usually has no effect on the market.
July non-farm payrolls came in at 187K versus 200,000 expected. June was revised down to 185,000 from 209,000. Hourly earnings rose 4% versus 3% expected, which matched June year over year at 4.4 versus 4.2% expected. Unemployment rate down to 3.5% versus 3.6% expected and down from 3.6%, signaling possible cooling job market with an increase in pay that's right at the current rate of inflation with less unemployment than expected. Seems to me the job market is indeed cooling, but I rather describe it as settling in.
Number seven, the Fed did kind of hint at slowing the pace at which they are going to increase rates. Then Saturday they did come out, one of the Fed chairs did come out and say that that they intend to raise rates going forward until they get inflation in line. So it's kind of a mixed bag of things, but we will see. This week we'll see how heavily they're influenced on the headlines, as energy did see an uptick, which is going to fetch headlines. And we did see a modest uptick in headline inflation.
So this week and next, these reports and numbers will start settling in and the media will start their take. Economists will voice their take and some Fed members might jump in and voice their take. The CPI comes out Thursday and that will be the highlight. If the media doesn't spin an overreaction for some very modest increases, we should see the market stay tame. If the media causes panic over headline inflation numbers and the Fed sees these numbers in an ominous light, we could be looking at some crazy intraday swings. We'll just have to wait and see.
I want to thank you again for tuning in and listening to what we have to say. If you like this content, don't forget to go out there and hit that like button, smash those notifications, and also we want to let you guys know that we know that there is a concern with the interest rates being elevated, but we do have ways around that. We have permanent buy downs. We have 2-1 buy downs. We have certain things that we can look at to soften the blow, so to speak. So give the Landry team a call. We want to talk to you. We want to discuss some options with you. If you're looking to purchase a home, if you're looking to refinance because, I don't know, maybe the debt load is starting to strap the monthly budget, we want to take a look at everything for you and see if there's anything that we can do to get you where you want to be. Thank you again, and get out there, smash the like button. I think it's hit the like button and smash the notification button. Might be the other way around.